Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Craig Hemke. We're going to be recapping some of the commitment of trader reports, as well as also touching on something we focused on in last weekend's show out of TD Securities and their senior commodity strategist, talking about fund positioning in the precious metals. That all ties in with those commitment of trader reports. Craig is the founder and editor of TF Metals Report, which we will link to in the show notes so you can follow along with what Craig has to say on the markets, the economy, and the metals. Craig, first things first, let's talk about the commitment of traders reports. And again, that report out of TD Securities, senior commodity strategist Daniel Galley, he just laid out the fact that what he judges as positioning for macro funds, he's seeing them as really the most bullish he's seen in a long time for gold. 10-year lows in terms of visible shorts. Really, everyone's loaded up on the long side of that gold trade. Craig, are you seeing the same thing within the CoT reports, and any nuances, please?
Well, hi, guys. It's funny, Corey, you asked me that. Do you remember the three of us talked about sometime last month about that report? I think it was like a Reuters or a Bloomberg report about how those funds were net short across the commodity sector, 20 commodities, as much as like at the most they've been in 20 years. Remember that?
Yep, I do.
Yep. And so it's interesting that I'm sure gold and silver were probably counted in that amongst the grains and the softs and crude oil and all that kind of jazz. So you got 18 of them where they're obviously short, and 20 where they're long, which is kind of interesting in its own right. Yeah, it is. I've been, obviously, this is all part of what I do and have done now for 15 years. And you have to track the commitment of traders report, if anything, because, well, if you believe as I do, the futures tail wags the spot dog. And so if the futures market and the trading of derivatives is the thing that drives price in the short term, long term, we can talk about fundamentals like central bank gold demand or yearly supply deficits in silver or stuff like that. I mean, that all matters, but not like on a daily or weekly basis. It's the futures market. You got to have buyers and sellers, right? And so we're in a position now, and again, you have to follow the commitment of traders report that comes out every Friday, just for kind of general trends. And you also have to understand those positions from a historical basis. You can't just pick up one report and go, oh, this is bullish or this is bearish, if you don't have the historical numbers that then you can apply with, okay, the last time you had levels like this, or the last 3 or 5 or 18 times you had levels like this, what did price do next? Okay, that's how you can use this information. And so I'm sure what you're referencing, Corey, is at present, in gold in particular, we have extremely large, whether you want to categorize them all together as large speculators, or if you want to break into the nitty gritty of the report and call them trading funds and hedge funds and the like, really large long positions and not so big short positions. And so a net position where you subtract the net from, or the short from the long, at some of the highest levels we've seen since 2020, before that maybe 2016. And so it's one of those things that when you look at that stuff, it can make you at least be a little more conservative in your outlook. Doesn't mean you can't have more people come in, more funds come in, and keep buying, keep the train rolling. But you also, or maybe you're, at least from a historical perspective, you're close to where everybody in the past that's going to buy and get active has already bought and gotten active. And so that leaves you looking around wondering who's going to buy next. And so it can, kind of keep your momentum in check when you get to levels like this.
Yeah, I think that's a solid point, Greg, and that's what I was going to ask you. Do you think everybody's already bought that was going to bought? But then again, in the backdrop of the same funds a lot of times being short many of the other commodities, I guess it shows a bid for a safe haven in gold as opposed to maybe a slowdown in the economy and some of the other commodities. Do you think that with the rate cutting cycle usually being wind at gold's back, that it could still keep running based on that? Or is it a situation where it's so overbought, maybe people use gold to liquidate it to fund other sectors that may roll over?
Yes, that's true too. And it also, but as we saw 5 weeks ago, Remember that on the morning of August the 5th, when you had the carry trade unwind and everybody equities looked like they're down 1,000 points, and anything with a bid was getting liquidated. And gold has a bid 23 hours a day, and futures do. So you recall that morning of Monday the 5th, while the equity futures were kind of melting away, but the New York Stock Exchange wasn't going to open until 9:30 in the morning Eastern. Well, between about 2 and 6, 2 and 7 Eastern, gold fell $100 because it had a bid. And so that's one of these, knowing this commitment of trader structure where you got all these funds that are long. I'm not saying that they all would immediately liquidate because they're getting margin calls and they're looking for cash, but they're probably not just long gold. And so that is something that when you get these big positions like this, that you got to be wary of. Because if, again, I don't see it coming at present. There are people worried about today, Monday, being a down day because Monday, August the 5th had been a down day. And we dumped after the employment report again back on Friday. And so it was like, oh, we've seen this movie before. Well, yeah, but there wasn't the strengthening yen and the yen carry trade stuff. I mean, there was underlying factors back on August the 5th that were driving that aren't present today. But if we do get into seasonally not the best of times, September and October for equities, if we do get into global liquidity event, global margin call event, and those longs are going to be subject to getting liquidated, and that's a lot of selling pressure. So it's something that people need to be aware of in looking at where pricing is at present.
So, Craig, let's also look globally. We've talked about just how supportive China and India have been for the gold price. I've also listened to a couple other podcasts that have outlined the scenario where, because those markets have done so poorly, that has also pushed some of those investors into gold. Craig, what's your assessment of just how sustainable, just how stable the demand out of China and India could continue to be to hold gold around where it is or even push it higher?
Well, again, it's a hard one to quantify. Long term, right? I mean, it's good stuff. Short term, it's really hard to say if is that impacting price this week sort of thing. And typically that's not the case. But you look at long-term trends like that. Well, okay, if their economy's slowing down, if China's buying less commodities, well, that impacts iron ore and copper and all these other things, and that drives those prices lower. And then machines on this side of the world see copper going down, and so then they sell silver at the same time. So you get all that kind of connectivity like that. Now, on the flip side, I think there's a clear historical correlation between higher gold prices and then ramping silver demand in India. We get into the wedding season, a lot of time that's physically a big time for gold in India, but if in periods where the price has been rallying, they tend to shift towards silver, and all of a sudden you get an uptick in silver demand. So there are a lot of different trends coming out of the east that need to be monitored. I don't know, I am curious. Let's just I'm stumbling for the right word, to watch how things trade in the next 6 weeks. There's so many people, again, whether it's based in reality or not, but a lot of people wondering about what's going to happen at this BRICS summit in October. A lot of speculation that they're going to at least unveil a plan, or at least mention that they've discussed having a plan of their own trading currency for trade amongst themselves. And then there's further speculation that would involve some kind of gold backing. So all of those things could positively gold demand going forward too. Anyway, it's a long answer, and I may have really veered away from the basis of your question, Corey. But let's just sum it up. Eastern demand remains strong for both metals, and that probably underpins price pretty well.
Well, Craig, in that answer, you brought up that Indian wedding season demand, that some buyers may shift over to silver along with gold just because it's easier to get more quantity of silver than it is to get a big quantity of gold. Do you think that bodes well for if we do see a run higher in gold in the Western demand side of things, that eventually some buyers have that same revelation that, hey, I may not be able to stack a lot of gold, but I could sure stack more silver? I guess I'm asking, can silver finally start catching up?
It can. I guess the first thing that comes to my mind, though, Shad, is the discussions that the three of us had back in February and then in March as gold started breaking out, because silver was really lagging. And especially in March, gold's running up to 2,400 and beyond. And yet silver's still messing around at about 24.50, maybe 25. And remember, we talked about, okay, but at some point, this near 100 to 1 gold silver ratio is probably not going to hold. You're not going to see gold go to 2,500 and silver stay at 25. And that's the case. Here we are, 2,500. And I mean, silver's not at 25, it's 28 or 9, but that it did eventually kind of drag it forward. And so I think that's ultimately what happens again. I don't know. It kind of begs another question that goes back to the commitment of traders report. When price broke out of what was a 3.5-year range on the 1st of March, gold rallied from 2,000 and it broke out above to 2,100. Then it went to 2,450 in about 6 weeks. A 15-20% rally from where you started. Well, now gold just broke out from a 3.5-month range a couple of weeks ago, and it's just kind of sitting there. Can't seem to get through 25.60 on the December futures. And I think part of that is this commitment of treasury report that we talked about. It's just, a lot of buyers have already bought. And so it didn't quite have the same follow through this time. Maybe what'll happen, even though there's a lot of buyers in silver too, maybe what'll happen is that attention will shift. But that's going to take a lot more than just that to get silver going. We've talked quite a bit the last couple of weeks. We need copper to turn back higher, crude oil going back higher, those sorts of things. And we're not really seeing that happening yet.
No, we are not. But does this all simply tie into this one universal chart that you've talked to us about, where if the markets are up, everything else seems to be up? If the markets are going through a period of weakness, like really what we saw last week, then everything else commodity-wise drops with it, albeit gold at least is more treading sideways recently.
Well, that's true. You look at, they're pretty stout correlation on down days in the equity market with the precious metals too. And again, it almost makes you feel like something's going down, and so some kind of pair trade is getting liquidated, or the markets are going down. Instead of getting a safe haven bid initially, gold just goes and silver goes down with it. Yeah, it does kind of go back toward the one universal chart of a risk asset versus what's considered risk off. And everything gets lumped together as a risk asset. And the one thing that remains is maybe the dollar index or maybe bonds as an opposite. I don't know. I'll draw back again, though, to this idea that this is going to be a very interesting 6-8 weeks for all markets. A lot of it keying off of what happens next week with the FOMC. I think it's generally understood and expected that you're going to get a 25 basis point rate cut. What Powell says in the press conference after and how he says it, how he answers certain questions are going to go a long ways to determining whether we kind of charge forward in the back half of this month into October or not. So that'll impact the equities as well. So we'll see as we go through this week how things play out with the CPI and some other data. But boy, next week's going to be the one that really sets the tone for maybe even the balance of the fourth quarter.
Well, Craig, I was going to ask you, you're a betting man. What is your bet? Has the market already priced in the rate cut to the point where it'll be a sell the news event? Or could it be the kickoff of even another rally in equities and gold? Is it priced in where it's sell the news, or is it ready to rip higher?
Well, I've been trying to tell people on my site for about a month that this notion the Fed's going to cut 50 basis points, absent like a negative jobs print back on last Friday, there's no way. Powell he's a lawyer. Remember, he's not an economist by trade. He's a lawyer. So he's a pretty pragmatic guy. And so where he may sense that he needs to start an easing cycle. And again, I see this on Twitter all the time. I can't believe the Fed is thinking about cutting rates with the stock market all-time high. The Fed's not cutting rates based on today. I mean, they know, the three of us know, there's a lag effect on monetary policy, which is why when they started hiking too late, inflation got out of control because they couldn't hike fast enough to catch up to contain it. Well, now Powell's trying to look over the horizon and go, okay, it's not what the economy looks like on the 18th of September. He's thinking about what it's going to look like by the 18th of April. And so that's why you start cutting. But he's pragmatic enough that unless it was really dire, he wasn't going to do 50. And so when gold and silver were trading up and down daily on rate cut projections, and the hope, allegedly, that there was going to be 50 basis points. I mean, look what happened last Friday. I mean, the idea of a 50 basis point rate cut went from 25% likely to 60% likely, then down to 40% likely, then back up to 50, then finally down to 25, and gold bang, up, down, base opposite of that the whole time. We need to get that priced out, this idea of 50. And so to get back to your question, I think I'm going to look at it the other way. I think there's a little bit of a sell the rumor, buy the news in gold. Sell the rumor that it's going to be 50. And when the news actually hits that it's not 50 and it's 25 next Wednesday, and then with Powell's press conference, I think that may be in the run up Monday, Tuesday, and early Wednesday next week. That might be a low. Maybe get December futures down to 2,500 or just below where the trend line is and where the 50-day moving average is. That might be your low, from which then gold can rally into. It might peak out by late November or something like that.
Yeah, it's going to be so interesting to see what these markets do. I'm with you, Craig. I think it'll be a 25 basis point cut, but hey, it's kind of fun seeing all these people on both sides trying to really justify why it should be either 50 basis points, 25 basis points, or some that even want more than that. But the market reaction, well, we'll see, and it's usually the day after the statement, too, that really shows the direction of these markets. Oh, it's going to be a lot of fun, and I think very interesting to see how the market reacts to the upcoming Fed rate cut. I'm with you, Craig. I think it'll be 25 basis points, but I love hearing the arguments for the 50 basis points and even some of those that want even a larger rate cut. And look, this is going to be a cycle of rate cuts, but I think they're going to start off slow with 25 basis points. And also market reaction wise, I find it's always the day after the statement that gives us a bit more insights into at least that near-term direction and how traders are really digesting what comes out of the rate cut and also Powell's press conference. Again, you want to keep up to date with Craig, click on that link in the show notes, TF Metals Report. And Craig, we'll chat again next week.
Okay.